Yes, we are back, my friend, but don't look now. Even the S&Ps are making a new high, and we're getting a new high right here at the Tasty Live studios with my man Chris on the show. How are you, Chris?
Gentlemen. Good morning, Vietnam.
Good morning, Vietnam is right. Even the S&P's up 68, NASDAQ up 295, Russell up 59, and Dow up 360 and change. Go ahead, gloat.
You love to see it, gentlemen. Bond yields lower, stock prices higher, inflation's coming in. Alas, it might be a false dawn.
It might be a what?
It might be a false dawn. This is purely due to base effects in the data. We talked about this yesterday on Futures Power Hour and on Overtime, which was the data series, if you look at it, was going to see a big slump in the month of October. So for everyone celebrating today about this modest miss, not really even that big of a miss, according to the inimitable Josh Fabian, then you're looking at what will then be a rise again in November and December. There are reasons to be excited that inflation's coming down, no doubt about it. But we're not out of the woods just yet. And so for a market that is responding so positively here today in reaction to the CPI report, it makes me wonder how we're going to respond when inflation bumps higher in November and December.
Well, the market's, market likes a little good news. It's okay.
Even the S&P's up 72, so enough 72.
Yeah, it's a insane
in the membrane.
Insane in the membrane. Yeah, there's a lot of
certainly an outlier. If you looked at the zero DTEs this morning, which I tweeted about, I don't know what we call that now. Either way, we were looking basically at like a 0.71% move in either direction for the S&P, 0.88% move for the NASDAQ through the end of today's session. We're certainly seeing something on the edges of that, in part because this is an outlier report. But that's good news. Fed odds have fallen across the board. There's now a 99.7% chance of a hold in December. There's now a 96% chance of a hold in January. Rate cuts are on the horizon for March. It's everything everyone could have hoped for. We're living through the soft landing, folks. We may not even have a landing for this economy the way things are going, and if the government continues to spend the money the way that it has been, that's a story for another time, of course. But this is just a roundly good report, and the market's receiving it very, very well.
Yeah, the market likes to buy stuff like this. Likes it. I thought you could get a little pump and dump here on the opening. I thought it would be. I think if they were up like 30 or 35, they could have sold it off a little bit. That's what I thought was going to happen. But when they got up to, they kind of got to levels I don't think they can really turn them around at now. And I've said that before and been wrong, but it looks like
Chris
this morning,
is the best thing he could have been saying right now. Okay, this is the best.
Well, I sold a bunch of S&Ps, 15 handles lower, just because I thought at that 4480 level we'd be pretty good. But
you'll get a chance to cover them later today or maybe tonight.
Who said that? Well, then I should sell more right here, right?
Absolutely.
Yeah, I think it's time. I think that, usually when I'm wrong by 20 ticks, that's pretty good. Yeah, I think so. But we'll see.
Things have happened. Worse things have happened, right? NASDAQ here at its highest level since August 2nd, S&P 500 highest level since September 20th. At the end of the day, though, this is a technician's dream. We posted about this yesterday on the Tasty Live Traders blog. Go check it out. But the S&P and the NASDAQ have ended their series of lower highs and lower lows. They broke through their October swing highs here. Momentum has roundly improved across the board. We know that there's a big washout and bearish sentiment at the end of September going into the beginning of October. And so this comports with the view that 3 months out from that washout and bearish sentiment, you typically see a rise of about 9.8% in the S&P 500. It matches up with the seasonals for November, where the bulk of the gains for the fourth quarter have come in historically. And so everything is kind of just going according to plan. I think the good news here is that this isn't just a rally predicated on what's happening with the Federal Reserve. This was a pretty good earnings season too. 92% of companies through the end of last week reported, at least in the S&P 500, 4.1% earnings growth rate for the third quarter, the best earnings growth rate that we've seen in a year since the third quarter of 2022. It's not just because of expanding sales, which some people like to point to as, well, if prices are going up, then sales are going up. But no, it was also improving profit margins for most companies. In fact, most of the earnings beats are due to expanding profit margins. So corporations have gotten leaner. They've trimmed the fat. and you have an economy that's staying afloat here in the very short term, even if it decelerates here in the fourth quarter to a 2.5% growth rate from that very impressive 4.9% annualized in real term rate that we saw for the third quarter. The table is set. Santa Claus may be coming early here. The market looks like it wants to extend higher. And the NASDAQ itself, I mean, what can you say about the NASDAQ right now? It has a beautiful technical setup, what we call a bullish falling wedge, which the base comes at the yearly high. So a move to, through the yearly highs can't be ruled out in the very short term. I don't have any exposure in the NASDAQ specifically right now. I'm still holding on to that S&P 500 position we've been talking about a lot on Futures Power Hour and Overtime, 42.36 entry on the Wednesday of the Fed meeting. I plan on holding that. I like riding it. It's making me feel good this morning.
All right, you're killing me a little bit. I'll jump on the knife for you. 2 weeks ago, the market was falling apart. Nobody thought about anything about a new highs or anything else like that. Nobody thought about even the S&P being up 70. Nobody liked Biden. Nobody liked policies. Nobody liked anything. Just 2 weeks ago. What's changed in 2 weeks that makes this, except for price?
First of all, stop getting all your fundamental bullshit out. What are you talking about? Who cares about any of that stuff?
I'm disputing what he's saying.
I'm disputing what he's saying too, but not for all the reasons you just said. I'm disputing what he's saying because as a trader,
you haven't said anything.
I'm doing it with my actions. Okay. I'm saying as a trader, the reason that you sell into something like this is because they've come so far so fast and it's probably already priced in. And at this point, I think the path of least resistance is to fade everything. But it doesn't matter what the reasons are, is my point.
Okay.
Like, who cares what the reason is?
To address both of those things, actually, I think.
Who cares what the reason is? Like, we've always said that. Why do you care what the reason is?
Because I think if this is a move that's predicated on, say, short covering.
I don't have any anger.
I think your conversation is misguided.
I'm making money today, amazingly. I don't have any problem.
I understand that, but I think it's your discussion is misguided.
My discussion is not misguided because this is the kind of thing that you.
I think it's pointed to the wrong person.
Oh, you want me to point at him?
Yes.
Yeah, I was going to, but you jumped in with,
I started saying what you just said, and you hopped
Chris,
on my
everything
back.
I just said to him is on you. All those.
Well, nobody mentioned the falling ledge. Like, this is what kills me about.
To me, all those arguments are absolutely ridiculous because that is a master of the obvious, and I think unless you really believe that this is just the beginning and we're like at day one or day two, whatever it is.
He said we might go to new highs.
Well, then if you believe that we're going to new highs, then it's fine. But the other side of this is, we've already had in a very short period of time here, we have a number of stocks and that have led this rally, like Microsoft, like Nvidia, like a lot of the NASDAQ stocks, like the S&Ps for that matter, that have just rallied. We traded just under 4,100 or right at 4,100.
A little over 41.50, but yeah.
Or whatever. Well, we've just basically had a 10% rally in a matter of 2 weeks. That's what Tony said.
Sometimes I wonder what happened.
And we've had a 10% rally in 2 weeks. We've had even a bigger rally than that in the NASDAQ. We've had some of the few stocks that have led this rally have been just, completely out of control. I think you get to a point of I almost think that this feels like capitulation today.
It certainly could be a bluff. And I started off this whole thing with saying beware of false dawns. The data set was going to lead to a decline in headline inflation effectively no matter what. You'd have had to see like 0.6% month over month on headline to get a bump higher in inflation. So it was going to come down. And the way it shapes up right now for November, December means inflation is going to go get back up. So it's not, don't think that this is the end of the fight for inflation and rate cuts are right around the corner. The Fed's not going to change what they're doing. They're still going to hold tight. They're still going to go higher for longer. But you have an overcrowded short position in the bond market, plain and simple. The most short position in the futures market in history. People are just taking those positions off lower yields. That's exactly what the stock market wants. Now, in terms of a short-term trade, you're saying this is overdone. It's hard to disagree with that. You've seen how far we've run. We've seen how volatility has been crushed. Plain and simple. The catalysts, though, that are standing in the way of this market potentially moving higher, outside of the overdone conclusion, they're limited. There aren't many bond auctions this week, which have been problematic for markets in recent days. You have a 2-year floating rate auction next week. You have a 20-year bond auction next week. But this week, you're pretty much in the free and clear. No one cares about 13-week or 26-week T-bill sales in terms of making these kind of decisions. The economic data flow, you're going to have retail sales tomorrow. the earnings that have been coming out, Home Depot, Walmart, BJ's, TJX company, right? They've been pointing to a consumer that is perhaps slowing down, but still better than anticipated. So what's going to knock us off this perch here and now? And is it going to be the Israel-Hamas war? No, the market's benchmarked it. Don't care about it at all whatsoever. You can see that in gold and crude oil's price action. Volatility's been crushed in line with historical norms when you have an expansion of geopolitical event risk. Where's the issue for this market rally to continue to run to the upside? This is a pure momentum play at this point in time. And so fading a 4% move in the Russell, I absolutely understand that prerogative going too far too fast. But the market structure has improved. And there are a lot of people, remember, who came into this year very, very bearish on stocks. They have to play catch up into the end of the year. Fund managers, not traders, not active people like ourselves, but fund managers, people who are saying recession's coming, batten down the hatches, hide your kids, hide your wife. They missed out on the rally in the first half of the year. They've probably missed out on the rally here for the past 2.5 weeks. And so there's a big, big incentive in this market to chase right now, plain and simple.
I think that a couple things, and some of that I agree with, some of the chasing part, but I also think that just a couple things with respect to interest rates. First, I don't think the Fed has any intention of lowering rates at any time soon. I think they made that pretty clear, and I think that the Fed kind of watch tool at the CME confirmed that till late next year. The difference is that it doesn't matter what the Fed thinks. What matters is where the bonds are trading. And if the bonds are trading if the bonds take off here and stay over 115 and go to 116 or 117 or 118 or 119, the Fed's hands are tied. They have nothing. They have to lower rates, and they have to do it much quicker than the marketplace will dictate what the Fed does. It always does.
Agree.
So the Fed, it doesn't matter like at this point what the Fed says, because the marketplace will try to anticipate and will try to be, outrun the Fed. So the marketplace will make that decision, and the Fed has nothing to do with it. And so when you see bonds up over 2 points today, yeah, the real story here is if it holds this rally and they take out 116 and 117, whatever it is, the Fed's going to lower rates, and they're going to do it at a much faster pace. The other thing is, I don't think that as somebody that's watched the market for a long time and virtually every tick, I don't think it matters. I think it's all based on price extreme. And I think what you're going to see here is you may see a rotation into a beaten down index like the Russell, away from a crazy index that's just had crazy prices like the NASDAQ. I know today.
You're saying velocity of the move to the upside might.
Yeah, you might see the Russell and you might see the S&Ps continue to push this market higher, but I don't think the NASDAQ is going to be that much of a help. It's carried today on the coattails of, it's up 2% move on the coattails of just everything else that's happening.
Well, it's up 45% for the year. I mean, how much?
No, exactly. That's my point. And you're starting to see stocks today. I know that, listen, Apple's up 2 and Amazon's up 3 and, blah, blah, blah. But you're starting to see, as the S&Ps go higher here, NVIDIA's a couple bucks off its high and Microsoft's a couple bucks off its high, whatever it is. Tesla's a couple bucks off. It's not big yet because we haven't, I think on the first downtick, these stocks start to get a little ugly. And so I think it's a really interesting spot here to fade them. First, you have the round number at 4,500. Second, you have what looks like to be, binary. It's a binary event that causes, whatever kind of capitulation. And I don't think you can look much beyond. Again, the market will determine how good and how bad everything else is in the economy. The market's just kind of just a forward-looking thing, forward-looking indicator, forward-looking, measure, barometer, whatever you want to call it.
I agree. Stocks tend to bottom, 9 months before earnings do, and we just saw that the bottom in earnings came in last quarter. It looks like. When did the market start rallying? Last October. 9 months later, end of the second quarter. That all fits together. And to your point about the Fed cutting rates sooner than later, look, the average time between the last Fed hike and the first Fed cut is 8 months. The last time we had the Fed raise rates was July. What's 8 months after July? March. So a cut could be around the corner, and the bond market's behaving as if the Fed does need a cut. The market's going to get piss, though, for lack of a better phrase, if the Fed doesn't deliver those cuts, because quite frankly, then you go into a place where you could have over tightening, and then you get the economy then falling back into a recession, corporate earnings receding once more at a time when they really need not be. So this is not going to be a straight path forward. Powell and co. are the generals fighting the last war. They spent so much time talking about inflation being transitory in 2021 that in order to get the egg off their face, to restore their credibility, they feel this need to stay higher for longer right now. And this could lead to an uncomfortable period where bond yields are falling and stocks are rallying, and the Fed's saying, no, we may have to do more, wink, wink, nudge, nudge, when everyone knows they're just full of it. And it appears that we're in that window right now. So that's a good thing, ultimately, I think, for a risk appetite, for risk sentiment, particularly if you're a stock trader here, heading into the end of the year. But we've been talking for weeks, guys, about bond markets potentially carving out the bottom. The massive volumes that we saw in ZB at the end of September. The only time we've seen something comparable to that was at the highs, the exact highs, the capitulation you saw at the end of February 2020, beginning of March 2020, during the depths of the COVID era, of course. You see here that you have the biggest net short position in the history of the futures market in treasuries across the board. There are reasons to think that we've reached the lows, and if bond yields are coming off, small cap stocks, tech stocks, they're going to like that. They like lower interest rates, plain and simple. And so, yeah, if there's a fade intraday, I get it. But the structure of this market right now is set up for a potential chase into year end. You get into 2024, we can have a different conversation. But the next few weeks, skies are above.
I don't disagree with that. That's very possible. Let's think. So most interesting place here. It's 9 o'clock, Chris. Most interesting place here. Let's get specific.
We all agreed in an election year, you think about that they're going to reduce rates too. So I mean, we said that early.
I agree. And
of course.
The bonds got grossly oversold, and I think that they're, listen, we're just long bonds. So I'm not arguing with you. I'm long bonds here. I want them to go to, the perfect number for us is 118 or 119. So, I have no complaints. But let's talk specifics. If you want to get into something right here, you want to find a trade. Same goes for you, Tony. Mm-hmm. You want to find a trade here. What are you going to trade?
I think you got to look to ZB.
But ZB's had a monster move. It's 115.10 right now. What are you going to do?
I still think that you can absolutely look at selling a put spread here. I mean, you look at the volatility in the bond market, it's nothing at the short end of the curve compared to what you're seeing in ZB. Last time I saw this, before we popped on, the IVR in ZB was still 49.
Yeah.
You don't really see that often. Still high, still very high. So there's still, you could still place trades there on the curve. Otherwise, I think that you have to be looking at maybe a potential debit spread in something like the NASDAQ or the S&P 500 and take advantage of the environment while you can. Obviously, the volatility is not there, so you may not be able to collect as much premium if you're selling puts. But this is a market that has structural imbalance right now to carry it to the upside in the near term, plain and simple. And the holidays are next week. Really, what's going to stand in the way right now of a continuation?
Yeah, that's the big question. I mean, what's the trade here, Tony?
Man, you look around, there's nothing with high implied volatility. So he's right. You might have to go to the debit side, but I think it's more of like a diagonal spread. And that would be diagonal side to the put side. That would be me. On individual stocks, I'm not talking about S&Ps.
I don't think the S&Ps, there's anything there. I think you got to be short S&Ps, just general principle at 4,500. You take your shot. That cleanest shot is short S&Ps at 4,500. Or NASDAQ, where are we at 46 at 16,000? We're 100 points away. I think that's the cleanest shot on the board, and I kind of like it.
But you got low implied volatility everywhere.
Yep, you got low implied volatility anywhere, and you got stocks that are, stratospheric. I mean, you have hyperbolic stocks.
81. I mean, so far,
Yeah, but you got stocks like Microsoft that haven't had a downtick in what, 12 straight days? Mm-hmm. Nvidia, yes. 15 straight days. I mean, these things they're stretched. They're hoping somebody comes in here and takes them out of the upside. And I'm not kidding. That's what I think. They're just like, hey, keep this going because we got stuff to sell.
But he likes to break out. I
know, but there's
his play. And I get it. For all the reasons he said, going into the end of the year, I get it. I just think it's exhausted. Anyway.
Yeah. All right,
that's
Chris.
What makes a market.
Give your last word if there's something that you really love.
I love the stocks. That's it. Buy the dip. Buy the dip. If we get a dip, buy the dip.
I dip, you dip, we all dip. Buy the dip.
Sounds good. We'll take a quick 90-second break. We'll come back. We got more Tasty Live with a market measure next.